overall, I believe we're kind of entering into a recessionary time. I think things are slowing. Things are going to become difficult. I think the next 12 months is probably going to be a very big wild ride for most investors. And I think investors are going to feel a lot of pain, I think, even in the real estate market. I think it's a little bit delayed usually from the stock market. And that's where most investors, though, have a huge chunk of their wealth. And once the real estate pricing starts to drop, people start to feel like they're bleeding money everywhere. And that, makes people clam up and close their wallets. And so that's kind of where I think we are. I think we're in a topping phase of the equities market, and AI kind of stretched things above and beyond.
Welcome to Discourse with Christian. I'm your host, Christian White, and today's guest is Chris Vermeulen. Chris is the founder and chief investment officer of the Technical Traders. He is the author of Technical Trading Mastery and co-author of Asset Revesting. Chris, thanks so much for being on the show today.
Hey, thanks for having me, Christian. It's a pleasure.
Would love to start off asking you, what's your current take on the global economy and financial markets?
Yeah, that's a big question. I'm a technical analyst, so I follow the data. I don't go on the news or politics. I just purely follow what price and momentum and trends are doing between assets and stocks and currencies. Even economic data, I take a look what's going on. My view is this market is slowly getting, we've had a very strong rally and bounce recently, but overall, I believe we're kind of entering into a recessionary time. I think things are slowing. Things are going to become difficult. I think the next 12 months is probably going to be a very big wild ride for most investors. And I think investors are going to feel a lot of pain, I think, even in the real estate market. I think it's a little bit delayed usually from the stock market. And that's where most investors, though, have a huge chunk of their wealth. And once the real estate pricing starts to drop, people start to feel like they're bleeding money everywhere. And that, makes people clam up and close their wallets. And so that's kind of where I think we are. I think we're in a topping phase of the equities market, and AI kind of stretched things above and beyond. The tariffs created a real news-driven blip on the chart, a sharp drop and a kind of V-shaped kind of bounce at this point. And the big question is this market going to roll over here and start a new bear market, or is it going to try and grind higher for a little while before actually stalling out?
And as it relates to tariffs, could you unpack your thoughts on those and so on and so forth?
Yeah, I don't get too much into politics and tariffs. It's not my expertise whatsoever. I try and steer clear of all that stuff. But I think Trump's trying to level the playing field. If American products are getting huge tariffs in other countries, then I think he's trying to kind of try to level that playing field. Obviously, it creates a huge ripple for entrepreneurs and businesses. It's going to jack up pricing on products. Everybody's going to hurt. Sales are going to go down. Fewer things are going to be bought. So, I don't know what the end game plan is of where, the U.S. is going. Obviously, trying to make the country stronger. Sometimes in order to do that, you've got to kind of go backwards. You have to apply some pain and make some corrections along the way. And so I think that's kind of whatever his game plan is. This is obviously part of it. And sometimes change requires, difficult times in the process to maybe come out ahead in the long run.
Now, as it relates to the market, I know you've mentioned that it's been showing strength with small and micro caps, gaining traction. Can you unpack that?
Yeah, so I've been speaking to a lot of individual investors, a lot of people who use my newsletter. A lot of them are entrepreneurs. They import a lot of products, but not only that, but a lot of them even engineers and who do buildings. Like everything's gone on hold. Pretty much all the CEOs of the companies have pretty much just paused on building infrastructure, on hiring, on bringing in product, and it instantly hits these small cap companies. And they got hit really hard in this crash. And obviously, if tariffs are going to start to ease a little bit and they're not going to be quite as strict as what we once heard, that's going to help the small businesses. We have been seeing the small businesses kind of rebound fairly well over the last a week or so. But again, it's just so sensitive. These small companies are going to be under a lot of pressure. I talked to a bunch that are pretty much going to go under if the China tariffs stay what they are, like 140%, 135%. It's pretty much going to put them out of business. It's going to kill the toy business. I spoke to a lot of medical experts who have their products. Obviously, they're like American designed products, but manufactured overseas in China. And they have $500,000 worth of products to come over that are pre-sold, but it's going to cost like 2-3 times the price to get it here. And then they have no profits. And so they don't even want to bring it over because they're going to take a loss. they can't even afford that much product to come over because they just don't have the capital to bring it over with the tariffs. Like, so it's really causing a lot of problems, and I think this is probably the reason why Trump has kicked things down the road a little bit, kicked the can in terms of let's delay things. So all these companies who are literally hanging from a noose with all these products saying, I'm screwed. If I bring it over, I go bankrupt. I won't make any money. If I don't bring it over, I'm going to go bankrupt. He's at least allowing everybody to bring their products over that have already ordered and all that stuff. This is the way I see it. And to kind of at least give them a fighting chance going forward. And I used to run an importing business. I used to have products manufactured overseas. So I understand the whole bringing container loads over and the tariffs and all that stuff. And you need a lot of time. I mean, he's delayed it a couple times now, which is great because it does take 3, 4, 5 months sometimes for specific products to be manufactured and then shipped over.
And as it relates to gold and commodities, I know you've mentioned that gold is seeing a sharp outflows. Can you share your latest thoughts on that?
Yeah, so gold has been like the favored commodity for a little while. We've seen gold just screaming to all-time highs. If you're not in gold, you probably have FOMO. You wish you had gold, but we've been seeing gold pull back in the last couple of weeks. It's been pretty volatile. Typically, a big day for gold, a big moving day, is like 1%. We've been seeing 2.5, 3.5, 4% moves in gold on a daily basis, and that is huge. That usually is a sign that things are getting close to a major top. Everybody wanted gold. It seems like everybody's kind of piled in. That play, I feel like, is over. And right now we're seeing money come out of the precious metal space and it's going into equities. We're seeing more speculative stocks actually moving higher. Like generally when people are nervous, they go into gold, utilities, consumer staples, bonds. And what we're seeing now is money's coming out of kind of all of those, and they're going into highly aggressive small cap stocks because a lot of investors think now that the markets are starting a new bull market. And I think that's what this strong recovery in the stock market has people thinking and feeling. And so money sloshes around in the financial markets, as you know. If it's coming out of one asset class, it's going to another one that has more potential opportunity. So it's coming out of gold right now and moving into risky, fast moving stocks at this point.
And I know you've mentioned about a dead cat bounce and things of that nature. Could you unpack that? And for those who aren't perhaps familiar with that term?
Yeah, so a dead cat bounce, it sounds like a terrible term, but it's actually a technical term in the financial space. And more or less what it means is the stock market has finished going up. It's traded sideways for a long time. And then it finally had a sharp drop to the downside. And that's what we saw February, March, and early April of this year. We saw about a 20% correction in the stock market. And then what happens after that upward trend comes to an end with that abrupt drop is you have a bounce, a technical bounce. It's called a bear market rally. It can be called a dead cat bounce. And really the market bounces up and it'll eventually go up and try and test the highs or move up into a resistance zone. Eventually it'll run out of steam and then roll over. And then we go into a much deeper correction. So we could see a bear market really start over the next month or two. And it could drag out many months. It could drag out even years in some cases. The tech bubble, it took about 3 years to unwind and it took 16 years to recover from that price. And even though we've had this really strong bounce in the markets are up about 25, 28%. It doesn't mean that it's the start of a new bull market yet. In fact, we actually saw in the tech bubble, we saw a 47% first drop in the stock market, and then it rallied 64% as the dead cat bounce, and it got nowhere near the all-time highs. And then it rolled over and sold off even more. So I think what people get sucked into here is, yes, this move in the market, this bounce has been super strong. It sucks people in. They're like, this isn't a bounce, this is a rally. And I would say, yeah, it is a rally, but it's still a bounce. It's still a rally within a bear market, meaning it's going to probably go lower later. So I'm very leery of where this market is going to go. We are long the market at this point, riding this bounce higher as a kind of an active investor, but I have expectations it will roll over, and we'll focus on benefiting from falling prices down the road.
I see. And then still on the topic of gold and commodities just as a whole, you mentioned silver and gold miners, that's been trading lower, and you've also kind of covered oil kind of on a downward trajectory. Could you share that? more?
Yeah. So typically, if we go into a recession and the stock market starts to crash and sell off, we pretty much see most classes go down. There's kind of like forced liquidation. People have margin calls. Is generally leveraged. They always own more than what they can afford, and when they start to go against them, like the trades go against them, they have these margin calls, and it causes forced liquidation. Their brokers will just start selling off positions, and obviously that'll generally mean the economy is weakening, and there's going to be less demand. So investors naturally want to start selling off this stuff. So I'm expecting pretty much most asset classes to go down. I think we will see gold, silver, and miners. I think they will probably bottom before the stock market, and they'll become a very good opportunity, potentially late this year, early next year, as a major opportunity for a long term trade that could last 5 or 10 years. But again, they're going to get beat up with the overall market if it does go into a correction here.
Now, and as it relates to like sector rotation volatility, you mentioned, I believe it was the ARKW ETF, and so on and so forth. Could you kind of share your latest thoughts and findings on that? And
Yeah, so the ARK ETFs, that's just a company that creates these ETFs that have all kinds of really interesting small cap stocks, generally mixed in with a bunch of large tech, but they're really volatile. They can move very fast. And in 2000, after the COVID crisis, we saw a lot of these ARK ETFs rally, 100, 200, 300%, huge moves to the upside. The ARK ETFs are a really good gauge of the general market, the active trader, the emotional trader psychology of what they're doing. And the ARK ETFs really about a month and a half ago were the worst performing ETFs. You didn't want to hold them. They were number one most sold off. And nobody wanted them. And here they are now at the top of our hot list as the best investment right now, as the one performing the most. And this just goes to show how much the money is kind of flip flopping and sloshing from. Everybody moves out of them because they think the markets are crashing, and now they're all moving in. And now, just in the last couple of days, the ARK ETFs are now right up at the top. And to me, when we see these highly speculative trades outperforming everything else dramatically, which they are on a percentage basis, along with uranium stocks and Bitcoin and a whole bunch of things like that, that usually means the masses are, they've piled in. Most of them are probably in the market already, and there's not a whole lot more upside left. So you have to be very aware when you hit these extremes. When it's the best asset, you got to be ready for it to have a pullback. When it's the worst asset, nobody wants it. You got to actually start be looking and expecting a bottom to get put in. And so the ARK ETFs right now are saying, hey, this market is speculative. Everybody's betting on higher pricing. I talked about and saw the put call ratio, which is the options market yesterday. And the amount of people buying call options, meaning they're buying leverage, high leverage, to bet on a rising market. It's at a level that every time we see this, the market usually trades sideways or it sells off for a couple of months. So everybody, again, the most leveraged stocks, now they're applying leverage options to make even more money. And that is not a good sign. It's a contrarian play. When everybody's long and loading up and saying this is going to be good, we're going to make a fortune, it's usually kind of the opposite scenario in most cases.
And you mentioned Bitcoin. Could you share your thoughts? I know you've mentioned that it's still showing strength and so on and so forth, along with uranium.
Yeah, for sure. So Bitcoin moves a lot with the stock market. 9 out of 10 days, it's moving with the Nasdaq. So if the Nasdaq or the stock market rolls over, Bitcoin's going down, and I think Bitcoin will probably drop down into the 20,000 range, which is a huge drop. And that's if we go into a bear market phase. But Bitcoin on the monthly chart, if the stock market gets traction, if Bitcoin can hold its value, the monthly chart of Bitcoin is actually pointing to about $135,000 per Bitcoin. So Bitcoin is at a critical tipping point. It is about to pop and scream higher, or it is going to roll over with the overall market if the market rolls over, and it's going to crash and have a precipitous fall. So we're long Bitcoin. We've kind of locked in some gains temporarily or recently, and we're just waiting to see which way this market is going to go before we take any more action. But Bitcoin is in an uptrend along with the stock market, and it is pointing to higher pricing, and it could pop and rally pretty much any day here.
Yeah, I remember listening to you on another show about it reaching maybe 135 potentially, or something around there, depending on
Yeah.
on where things
Yeah.
go. Relating to market strategy and positioning, you've mentioned about a stage three market and choppiness and rotational volatility. Could you share that more?
Yeah,
Unpack
sure.
it.
So there's four stages to a market, to any asset class. More or less, a stage one, think of it as a base, a bottom. It's a sideways moving market. Stage ones you want to avoid. That's just choppy, difficult to make money. Stage two is an upward, it's a bull market phase. Everybody loves a bull market phase. A stage three is a topping phase. The markets are going sideways, lots of volatility. We have sector rotation, as you just mentioned, Christian, where one month one sector is hot, the next month that same sector is the worst. And we keep seeing this between, we track about 40 different sectors, and they're all over the place. So money doesn't know where to go. It's chasing the quickest, shiniest thing, but it only moves for a few weeks and then it rolls over and dies. So that's a signature of a stage three, a sideways kind of topping phase. After stage three, we go into a stage four, which is a financial reset, a bear market phase. And that is where I believe we're headed to if this market does top out here over the next month or so. And we need to be aware of. So understanding where you are in those four stages, when I look at it on the daily charts, that tells us if we're in like a bull market or bear market phase. But these four stages actually work on all time frames. You can use it on the 1 minute chart to identify where it is in these cycles. And depending on where something is trading in a stage, every stage requires a different strategy, which most people don't realize. They always have like one strategy and they try and trade it all the time. But there's four of these different stages. And people don't realize you need to change your strategies with the stages because volatility changes, breakouts don't have follow through in certain ones. And it's a very different game, especially trading a falling market.
And as it relates to kind of overall watch list and broad market health, and pertaining to the Magnificent Seven ETF breaking out but faces resistance overhead, can you maybe dive in a little bit on that?
Yeah, well, the Magnificent Seven, I mean, I used to never really follow, I never followed NVIDIA and Tesla and all of those. And then AI kind of came in and really took over. Everybody started chasing, NVIDIA, and then the Magnificent Seven became more of a thing. And now everybody wants to own like the basket of them or multiple of them. And so I do track the Magnificent Seven. And there's an ETF for it, MAGS, MAGS, allows you to kind of get a basket of what those seven stocks are doing as a whole. And so I don't, while I don't use it for our trade signals, it's nice to know what it's doing, because if it has a bullish chart pattern and it's pointing higher, it's probably going to drag the markets higher with it. And that's what we've seen over the last couple of years. Really, we've seen the Magnificent Seven drag the S&P 500 and the Nasdaq higher. Meanwhile, the majority of stocks in general, if you were to look at all the thousands of stocks out there, most of them are nowhere near the highs. And so it's the camouflage market. The markets have a great way of making people think, oh, my portfolio should be huge. It should be going up. But most people pick all these random other stocks and they realize if I just bought the index or the Mag 7s, I'd be doing well. But instead I picked all these random individual stocks and they're all down 20, 30, 40%. So understanding what the Mag 7 are doing, is it in a bullish uptrend? Is it in a bearish downtrend? Is going to give you a good understanding of what to expect from stocks in general. When the stock market goes up, think of it like the ocean. It's a rising tide. All boats go up. And that's all stocks pretty much go up in a bull market. In a bear market, when the tide is going down, almost all stocks and commodities go down as well. So you need to know if you are in a bull market or bear market phase, and then you can zoom in on the shorter term charts and make sure you trade with that underlying trend for your opportunities.
And I wrote it down on my notes here. Preferring to see equal weighted breakout as a true bullish signal. Can you share that more?
Sorry, what did you say there?
Oh, I'm sorry. I have down on my notes here that you prefer to see equal weighted breakout as a true bullish signal, as it relates to any observations that you have as far as bullish signals go. Can you dispense to
Yeah.
the audience? Yeah.
Yeah, so I like to see like a broad market. I like to see the majority of stocks all moving together, like the whole basket of stocks. When they're all moving together, we get a big breakout. A broad market rally means people are moving into all stocks. They're not just picking the most leveraged ones or the most speculative ones. Because right now, money's they're all going into the Magnificent Seven one day, and then the next day they're going into all the small caps and the micro caps. In a perfect world, we see small caps, mid caps, large caps, mega caps, all moving up and down together. And that's just more or less telling us the money flow is moving in and out in a comfortable way. But when money is just flowing to particular pockets of those stocks, it's not a broad market rally. It's people just dancing around trying to make profit, but they're not committing to just investing in things and rising the tide.
And then I know you've covered defensive rotation signs and things of that nature. Obviously, capital moving out of gold into defensive stock sectors instead of just staying in commodities. Can you unpack that perhaps a bit?
Yeah, so commodities tend to do well in the late stages of a stock market top and just before an economic recession. And the Canadian Stock Exchange is a good example of that. The TSX it's heavy weighted with we've got energy, we've got precious metals, resources, so it tends to hold up and do a bit better. People naturally, when they get nervous, they move towards commodities because, for example, the U.S. obviously had the financial crisis and banks went bankrupt and people lost their shirts and their homes. Um, so right now, as when people get nervous, they're like, well, if I sell my stocks, my money's still stuck in a bank. And if that bank could go under because everything seems to be falling apart, people don't trust the banks. They don't trust the financial system. And so people will liquidate their stocks and things and they'll move it over into commodities, into physical assets, being like, hey, I can at least go get a bar of gold. If something falls apart, it's not in a bank that was gambling my money and they blew themselves up and took my account with it. So commodities tend to do well or hold up better while the stock market starts to struggle. And that's exactly what we've seen. Other than oil, oil has been going down. I think that's because I think a lot of investors see increased production, which means lower oil pricing. I think a lot of people also see the economy potentially slowing, and that means less need for it. So oil is kind of diverging, but when it comes to more like precious metals, we tend to see those commodities move higher and as a defensive play and a way to get out of the financial system. It's usually a short window though. Like they've been performing well recently for the last several months, but once the bear market starts, there is really no safe haven other than maybe to move to a currency or to bet on falling pricing and actually profit from collapsing markets.
And could you perhaps share things that are not receiving enough attention that perhaps keep you up at night, or that you try and emphasize to perhaps your clients and things of that nature?
Yeah. So, when we're in this type of market condition where the markets could start a new bull market, they could roll over and crash for many years. When there's huge volatility like we've seen, sometimes the best position is a cash position and just collecting your interest. It's the most boring position until everything falls apart and you realize this is the smartest thing I have ever done. And there's times where you just need to step aside. It's not about trying to how can I make as much money as I can this year, which is the mentality of most people, and it's the wrong mentality because there's times when you should think like that and take action, but there's also times like now where it's like, who cares about the volatility? Volatility is actually dangerous. Let's step aside. Let's live life. Let's relax while all this shakes out this year. Once there's a clear direction, either a full on bear market has started, maybe a couple months from now, or a new bull market has started and all the signs of strength are there, then you get repositioned and get back in. I would much rather um, miss out on some gains and buy into the stock market later when it's clearly in its new bull market and you get in and it just keeps going higher than to hold on to something right now because you think you need to be in something and be diversified, only for you to realize you're wasting time. It's a roller coaster ride emotionally, and it's really a coin toss at this point. So, I think the thing most people don't see is just moving to cash and being happy with what you have, your lifestyle and your wealth level until there's an opportunity to benefit from it. You might as well not just, have it on a coin toss play right here.
And anything else that you'd like to dispense to the audience?
Well, I think one of the really interesting points I think a lot of investors don't realize is how dangerous dividend stocks are. I actually touched on this on my YouTube channel and video a couple of days ago. Uh, Dividend stocks are like a ticking time bomb for investors. If you're like 50 plus, I cover the dangers of it in a nutshell. When the stock market collapses, dividend stocks collapse even more. So if you're like, oh, the stock market's going to fall, during COVID, it's going to call the stock market fell 34%, the S&P 500. Well, dividend stocks fell on average about 47%. And here we're led to believe, oh, you can get these extra yields. You're taking all this risk for an extra 3% maybe a year, but you could lose a lot more if it goes against you. It's really volatile. And one of the reasons why it does that is the majority of the money in the stock market are from investors 50 plus. They're the ones who have got the capital, they're heavily invested, they've been letting it grow. And what happens is when the market starts to go down, these retirees and investors, they all start to panic at the same time because they're all very similar. They're successful, they're older, they don't want to lose their lifestyle. They have regular income to support their lifestyle. So they all panic at the same time. And when they all start to panic and call their advisors, they're all selling the same big blue chips, the same dividend stocks at the same time. So it's a focused selling pressure on just dividend stocks. And they fall the hardest. They fell more in 2008. They've fallen more recently. They're pretty dangerous, but people don't realize it. And so I think that's one of the biggest things is if somebody could go to talk to their advisor or look at their portfolio and say, hey, 2008 happens again, what will my portfolio do? 99% of investors will be like, if they actually get an answer saying, well, you could lose 40 or 50%, almost everyone will be like, there's no way in hell I want to do that. And that's just the old way of investing. That's the mentality. That's the way financial advisors are kind of actually forced into. If they deviate from the buy and hold stocks and bonds and they lose money, they can get sued. And I talk to them all the time. They're like, Chris, you're right. It's like, we kind of have to do it or we're on the hook. And he's like, if everybody loses together, we're not in trouble because it's the group, the crowded play, and it's what Wall Street and the financial system is kind of designed for. So that's the most important thing is for people to understand. That's what asset revesting, the book that you purchased there, is all about. It's like, if an asset's not going up, let's just move our money out of it. Let's preserve our wealth. Let's keep it. And then we'll find a different asset. We could go into currency. We could go into bonds. I think that's what people need to understand is we're coming to a point where you could have your life savings and lifestyle kind of wiped out. And it's way better to protect it and miss out on some gains than to absolutely get hammered and wish you just knew or took your money out, while things were uncertain.
As it relates to misconceptions and things of that nature, any comments on that?
Yeah, I mean, there's the whole, I think the whole financial system, like diversification in general, is a huge misconception. People think being diversified is safer. There's a few ways to look at it. More or less, if you're diversified, you're going to have some assets rocketing higher in value. But then because you're diversified, you're going to have a bunch that are also plummeting in value. And so you've got winners, you've got losers, and then they kind of neutralize each other. So instead of having a really good gain, you have this mediocre average return, which is the buy and hold. It's relatively low. It carries a ton of volatility. So that's one of the big problems, misconceptions with it. I think people need to also realize, like people who get diversified across stocks, I talk to a lot of people, they're like, I have this ETF in this sector, and I own these stocks and all these stocks. They're like, I'm diversified. I'm like, no, they're all stocks. You own one asset class, a whole bunch of them, but you own it. And when the market goes down, they're all going down. They're all the same trade, just some move faster or slower than others. And people don't realize that. And the other thing they don't realize is when you go from owning, say, the stock index, and you drop to a sector, well, sectors move a lot more. The stock market might fall 40%, a sector might fall 60%. And then if you go to an even smaller asset, like, oh, I bought this one stock, well, in a bear market, most of the stocks are going to go down like 70, 80, 90%. And so they have this huge diversified portfolio. They think they are bulletproof. And here, as they go to sectors and stocks, all they're doing is increasing the risk even more because they're going into things that are going to drop even more than the stock index itself. And so what most portfolios are a ticking time bomb. They have no idea what they're doing. And it's just all false belief, misconception. It's just the norm. People think if everybody's doing it, it's the right thing to do. And it's really not. When it comes to managing money, if you want to preserve wealth and grow it, You don't do what the masses do. It's you talk to anybody who's been holding investments for 10, 20 years, they'll be like COVID and 2008 and the tech bubble were a nightmare. You don't need to go through those. You can completely navigate them by following price, and that's what I specialize on.
Yeah, when I think about people that I've interacted with over the years, whether it's certain, I don't want to make a blanket statement, but certain financial advisors or even my folks and such, I think of how I don't want to say all baby boomers, but some of them where it's very conservative, very methodical approach, as it relates to kind of the what do they call it, 60-40 portfolio, things of that nature. And it's always striking to get resistance when I've listened to people such as yourself and others that I've had on the show, which is counter to that and some of the resistance that you get.
Yeah, it's huge. There's two mentalities in the market. It's like diversified buy and hold dividend stocks, like the general way, which is fine if you're really young. But if you're near retirement, the last thing you want to do is go into 10 years of not having any return and having your portfolio down huge. So you got the buy and hold people, and then you've got the super active traders. And there's all kinds of studies across North America, Taiwan, Brazil, all kinds of places that have proven the more you trade, the more money you lose. And so what I focus on is like kind of the sweet spot. We're far from active trading, but we rotate our capital, from stocks to bonds to currency to cash, and we just kind of rotate through those, whichever asset is moving. And so we just do enough to make sure when something rolls over and starts to go down, we move out and we move to something that's just starting to go up. And I think that's like such an important aspect to attacking the markets. And I like to always use the analogy of the ocean. So knowing if the tide is going up or down allows you to know, should I be holding stocks or not? And then I always look at ourselves as like surfers. When you look at a surfer floating out past the break, what are they waiting for? They're waiting for a set of waves to roll through. You can see those surfable waves, those sets roll in. And the stock market has like 5 to 12 sets of waves that roll through these assets every year. And so we wait in cash earning interest until an asset rolls by and we're like, okay, that meets our criteria. We hop on, we ride that wave. And the nice thing about riding a strong wave like that, a swell, is you also know when it's starting to get weak, when it's about to break. So you can carve off that trade, get out of it, and then wait for the next one. And so that's what we do. We just have like 5 to 12 repositions each year. And we just kind of catch each wave that rolls through it. And believe it or not, we're in cash about 40% of the year, just earning interest. So half the noise and the BS that goes on in the markets, we're just sitting in cash and we're like, oh, it's nice not to be in that and have all that chaos. But when we are in a trade, we're catching these really nice waves and building our account. And so that's what differentiates what I do, with the buy and hold and the active traders. We're like, no, we're going to methodically wait for a wave to roll in, hop on it. We have all the tools to identify, is this a strong wave? Is there momentum? Is it worth jumping on? And again, that's what I focus on is technical analysis. We can gauge with data, momentum, volume flows, all of that.
Yeah, when you mentioned about the kind of like the tide and riding the wave and such, you reminded me of kind of like in nature, cycles and balance and things of that nature. Of course, like Fibonacci sequences and geometry. And as it relates to that, have you incorporated? I mean, obviously Fibonacci people are well known about that, but I mean, other principles that are even outside of kind of a quantitative element of things. Trying to frame it right. Has that added to your development as a trader and as a market analyst and things of that nature?
For sure. I mean, I think everything's connected in a way. Like the universe is vibrations. I'm big into Fibonacci theory and Fibonacci measured moves and retracements. We can gauge how far something should run, how far it should pull back. We use it all the time for shorter term trades. The whole world of vibrating, I have custom indicators that allow us to get a gauge of sentiment. Do people have panic in the market? We can gauge when people are panicking out of trades, dumping shares. We can also we pick up when people are panicking and they have FOMO. They're like, I'm missing out, and they're piling into the market. They don't care what price they pay. So these are just vibrations. And the stock market really is just the vibration of the masses who are playing it. It's just what they're thinking and feeling and what they're doing. And so I'm all about picking up on the sentiment. It's a huge part. It's the biggest part actually of our trading strategy is understanding the sentiment of what people are doing, the vibrations and the flows. And once we have nailed those down or enough of them meet our criteria, we're like, okay, first is the trend has to be in our direction and then the sentiment. And once those two line up, it's, that it's understanding that sentiment, that vibration. Like it's like if you're in a room and everybody's happy, and then somebody who's negative comes in and they make some negative comment, the whole room changes. We all pick up on it. So, we look for a trade that money's flowing in and it's a good vibe, and we move into that trade and we can sense when there's good energy, like money flowing in, and when there's bad energy and money flowing out. So it's kind of, you could say it's like a universal vibration, but we've created tools to be able to identify like these positive and negative flows into our strategy.
Yeah, I find it absolutely fascinating, and especially how I know we're on the topic of markets and things of that nature, but how even things that are in a completely different arena can tie in and augment one's understanding, so to speak. So I find it pretty fascinating.
I love the whole universe and vibrations. You think of somebody and then they call you or text you, or planetary alignment. Like I'm not big into it, but I know it's there. As different things happen with the planets. My parents used to have a hearing clinic, and on a full moon or certain particular planetary settings, like old people are sensitive to that stuff. Like they're like a higher reception to it, and they get a little kooky at certain times, and it's amazing. And so there's underlying forces that we don't fully understand, always at play, and I try to gauge and pick up on that stuff as part of our analysis.
Yeah, it's like it reminds me of a sacred geometry, things of
Yeah,
that nature. Yeah,
yeah.
Chris, how can people get in touch with you and learn more about you?
Sure. One of the best ways is just go to YouTube, The Technical Traders. You'll see my channel there. I share daily charts and videos that really will teach you and walk you through what's going on in the markets. I show the panic and the fear and these really cool movements of just people, waves of schools of fish of investors moving in one direction and the next each day. It's pretty amazing. Or they can go to my website, which is thetechnicaltraders.com. And I share what I do is I share morning videos. I share my trades. So everything I do with my own portfolio is what the newsletter is. I just tell everybody this is what I'm investing in. I'm buying this much of my portfolio. I only trade ETFs, so it's really straightforward. Mostly the indices, currencies, bonds, cash positions. So we're just rotating through those four biggest asset classes, and we just kind of ride the waves and have that 5 to 12 trades a year.
Awesome. Well, Chris, thanks so much for carving out the time to be on the show today. Appreciate you.
Thanks, Christian. Pleasure.
Quick ask: over half of you who watch the show regularly haven't yet subscribed. If you've enjoyed the show, you're finding value in it, subscribing is really the best way to support the channel. It's, of course, free. It literally takes 2 seconds, and it lets the algorithm know that this content matters. And of course, my commitment to you is going to be that I'm going to continue to bring on great guests, refine those questions. And of course, I'm always receptive to your feedback. If there's certain people that you'd like to have on, or certain questions, or this, that, and the other that you'd like to have as part of the show going forward, things of that nature, please let me know. I'm pretty easy to access. Anyhow, that's my commitment to you. If you can subscribe, that would mean a lot. Thanks.